Hey everyone, welcome back to Corporate Decoder, the place where we decode what companies are really saying in their shareholder reports. And oh boy, do we have a juicy one today. AiRWA Incorporated, the company formerly known as Connexa Sports Technologies, is back with its quarterly update, and it looks like there has been quite a shuffle going on. Alright, so we are diving into AiRWA Incorporated's latest filing of Form 10Q. Here we are looking at their performance up to the 31st of October 2025. And let me tell you, there have been some significant moves behind the scenes. This report gives us a peek into their financial health and their strategic direction. So let's get into it. First off, a quick note on share count. As of the 19th of December 2025, AiRWA Incorporated had 18,981,535 shares of common stock outstanding. Now, why is this important? Because it affects how much of the company each share represents and can influence stock price and investor value. Let's head over to the financial statements and start with the consolidated balance sheets. This is like a snapshot of what the company owns and what it owes at a specific point in time. Looking at the 30th of April 2025, we see total assets of about $329 million fast forward to the 31st of October 2025. And that number has jumped significantly to over $172 million. That is a massive increase likely due to new business activities and capital infusions. One thing that really stands out in the 31st of October 2025 balance sheet is the large amount of deposits at $253 million. This is largely for marketing, advertising, and technology development vendors with the expectation of future services. Or refunds. This is a big chunk of change being put aside for future growth. On the asset side, we also see intangible assets net, which includes things like patents and proprietary technology. These are valued at around $9 million as of October 2025, down from about $105 million in April 2025. This decrease might be due to amortization or a change in how they are valued. Now let's look at the liabilities. Total current liabilities for the 31st of October 2025 were about $67 million, which is pretty stable compared to the 30th of April 2025. So the company has managed its short-term debts well. Then we get to shareholders' equity. This is where things get really interesting. Additional paid. In capital shows a dramatic increase from about $191 million in April 2025 to over $191 million on the 31st of October 2025. This usually means a lot of new stock has been issued, likely through fundraising efforts. The accumulated deficit or retained earnings line shows a big shift. We went from a positive $61 million in retained earnings in April 2025 to a deficit of almost $27 million in October 2025. This indicates that while the company has raised a lot of cash, it has also incurred significant expenses, possibly related to its new ventures. Also notice the non-controlling interest, which was over $11 million in April 2025 and is zero by October 2025. This suggests that the company has fully acquired any interest it did not previously own in its subsidiaries, making them wholly owned. Moving on to the consolidated statements of operations and comprehensive income. This tells us about the company's performance over a period of time. For the 6-month periods ended the 31st of October, revenue saw a slight decrease from roughly $65 million in 2024 to $6 million in 2025. The 3-month period show a similar trend, with revenue dropping from about $33 million to $3 million. This is an 8% drop in both cases. An interesting change here is in selling and marketing expenses, which went from absolutely nothing in the prior year's periods to $450,000 in both the 6-month and 3-month periods of 2025. This is due to the start of amortizing agent fees related to their new TikTok advertising business venture. The general and administrative expenses have skyrocketed. They went from about $288,000 in the 6-month period of 2024 to over $25 million in 2025. That is a massive 773% increase. Similarly, for the 3-month period, expenses jumped from about $199,000 to $175 million. A 778% increase. This surge is attributed to Yem becoming a subsidiary of us. Nasdaq-listed company requiring more audit, investor relations, legal and director compensation costs. As a result of these exploding operating expenses, the operating income has taken a huge hit. It dropped from over $47 million in the 6-month period of 2024 to just $15 million in 2025. This is a 68% decrease for the 3-month period. It plummeted from over $23 million to a mere $54,000, a 98% drop. Now for the cash flow statements, this shows how cash moved in and out of the company. For the 6 months ended the 31st of October 2025, cash flow used in operating activities was a substantial $319 million. This is a huge change from the $178,000 provided in the prior year. This is mainly because of those new deposits, prepayments, and other receivables totaling about $377 million that were made for new business activities. These are basically advance payment. so that will be expensed in future periods, affecting current cash flow negatively. In investing activities, we see a major outflow of $36 million. This is for the payment to acquire the remaining 30% of their operating subsidiary YEM, making it wholly owned. Financing activities show a massive inflow of cash. The proceeds from the ATM offering were over $168 million. There was also $46 million from a private placement. This is how they funded operations and those large investments and deposits. And the result of all this is that cash and cash equivalents at the end of the period ballooned from just about $55,000 in April 2025 to over $105 million by October 2025. That is a serious influx of liquidity. Let's look at concentrations of risk. The company relies heavily on just a few customers. As of the 31st of October 2025, customer are represented 55% of accounts receivable. Customer D was 25% and customer E was 20%. That means essentially 100% of their accounts receivable is from these three custo. This is a significant risk if any one of them falters. Looking at revenue by region, Hong Kong contributed $25 million, United Kingdom $15 million, and the United States $2 million for the 6-month period ending the 31st of October 2025. This shows a diversified global reach for their technology licensing business. Note 4 details their intangible assets, specifically technology rights. These are valued at cost less accumulated amortization as of the 31st of October 2025. The net value is over $9 million. The total cost of these technology rights is about $148 million. The amortization expense for these intangible assets was about $15 million for both 6-month periods ending October 2025 and 2024. This is a consistent cost directly related to their revenue generation. Now, for shareholders' equity under note 13, things here have been very active as of the 31st of October 2025. They have 18,981,535 shares outstanding after a significant one for 50 reverse stock split. That became effective the 27th of October 25. This usually happens to increase the per share trading price and meet exchange listing requirements. The company made a private placement on the 19th of August 2025, issuing 400,000 shares of common stock, raising $46 million. And they also sold over 18 million shares in at-the-market offerings, netting about $1,686 million after fees. This shows a strong push to raise capital. Looking at subsequent events in November 2025, they sold another 35 million shares under their ATM facility, raising over $3 million. Then, on the 22nd of December 2025, they closed a registered direct offering, selling over 153 million shares and raising about $157 million. This indicates continuous fundraising activity post-reporting period. Alright, now we are in the management's discussion and analysis section. This is where the company explains its results in its own words. They reiterate that revenue is generated from license fees for their technology. The slight decrease in revenue is attributed to minor timing differences in license agreements. The new selling and marketing expenses are tied to their TikTok advertising venture, a new revenue stream they are developing. The massive increase in general and administrative expenses is again highlighted as a consequence of their subsidiary YEM going public and the associated compliance and professional service costs. Let's circle back to revenue. They saw a decrease of 8% for both the 6-month and 3-month periods ending the 31st of October 2025. Compared to the previous year, this is mainly due to these timing differences in license agreements. The company reports a significant increase in cash and cash equivalents of about $10.545 million from April 2025 to October 2025. This surge is fueled by collecting accounts receivable and the substantial funds raised through their ATM facility. Now, for the big picture on cash flow, net cash used in operating activities was a hefty $319 million for the 6 months ended the 31st of October 2025, a considerable drop from the small positive cash flow of $1978,000 in the prior year. This is largely due to those large upfront payments for deposits and prepayments for new business initiatives which will benefit future periods. They state that based on current plans, they believe they have enough cash for at least the next 12 months and can access capital markets if needed. Their future capital needs depend on market developments, the AiRWA exchange project, and potential acquisitions. So what is my take on all of this? Well, AiRWA Incorporated, known previously as Connexa Sports Technologies, is clearly in a phase of major transformation. They have successfully raised a significant amount of capital, positioning themselves for future growth primarily through their YEM subsidiary focused on matchmaking technology, and the exciting new AiRWA exchange for tokenizing real-world assets. The Massive increase in cash and the significant capital raises show good forward momentum. However, there are notable risks. The dramatic increase in general and administrative expenses is a concern. It could indicate operational inefficiencies or higher than expected costs for compliance, and growth. The heavy reliance on just 3 major customers for revenue and accounts receivable is also a significant concentration risk. Any disruption with these clients could severely impact the company. In conclusion, AiRWA Inc. is placing big bets on new ventures like the AiRWA exchange and expanding its yen business. While the capital raising is impressive, the increased operational costs and customer concentration warrant close observation. The company is definitely in an expansionary phase, but investors should watch closely how effectively they can manage these growing expenses and diversify their customer base. Alright, that is our deep dive into AiRWA Incorporated's latest filing. If you found this breakdown helpful, make sure to hit that like button and subscribe for more corporate insights. We have a fantastic community on Discord. Linked in the description below. Share your thoughts on AiRWA in the comments and join the conversation. See you next time on Corporate Decoder. Thanks for watching, everyone.